All right. Hello, everybody. Welcome to Wealthologist Live for September. I'm your host, Chris Hobart. Of course, we've got Jacob Woodrum next to me. We're thrilled to have you with us today. Going to be talking about a lot of good stuff.
Yeah.
In fact, we've got not just Jacob today, we've got two incredible minds. Not counting myself in that. It's not just the two. That'd be kind of self serving. Maybe I should say that. But hey. We've got myself, Jacob, our lead investment strategist, and then we're going to have Andrew, one of our senior wealth advisors, and also our go-to estate planning expert. Andrew Greer is going to be joining us in a little bit to be sharing a little bit as well. So should be good. Now, before we get started, while we're letting people kind of settle into this, I always like to tell a story, and I got a cool one this time. This one. Before we get into the talk about money and strategies and all that, I just want to share kind of a personal story that was just neat and kind of impactful. I recently had a chance to go to Jesse Itzler's house. Now, we were talking about this a little bit before. Not everybody knows that name. So Jesse Itzler, he's an entrepreneur, founder of Marquis Jets, investor in Zico Water, partial owner of the Atlanta Hawks. Boo. Sorry. He's
pretty impressive guy.
Pretty impressive guy. He's an ultra athlete, which is where I met him. He's also an author. He wrote the book Living with a Seal.
Oh, I didn't know that.
Which he lived with David Goggins for 30 days, and he actually told the whole story behind that. He said it's actually a 10-year process of that book. Wow. It wasn't 30 days.
Wow.
So you name it, this guy is impressive. But the thing that a lot of folks may know him for that's a little bit different, and real quick, I'm going to pop up this picture of Jesse and I. Yes, that is casual Chris. Real quick, as we talk about this, we went to his house to hang out, and he's got a great facility at his house to do saunas and cold plunges. And I've done cold plunges, but not with somebody like him before. So the water was 37.
He's pretty extreme too.
37
right?
degrees.
So, yeah.
We had to stay in there for 2 minutes, and I got to tell you what,
you stayed in for 2 minutes?
Oh, I stayed in for 2 minutes 3 times. I did 3 times, and it was a lot. But all that to say, so that's why I'm so casual there. We had just gotten done with some cold plunges and stuff. But where a lot of folks know Jesse from quite well, or might know his wife, is Sarah Blakely. Mm-hmm. Now, Sarah Blakely, she's the brilliant founder of Spanx, and she was there too. So I had a chance to interact with her. I did not get a picture with her because I when she was hanging out with us, I was all sweaty from the steam room, and I thought it might be a little but here's the thing. What I got from all this, Jacob, is when you're around people who think big, and Sarah Blakely, she sold her business for over $1 billion. Wow. That's thinking big.
Wild, right?
The other thing that I noticed though is that they weren't afraid to fail. They talked about some of their failures, but really they lead with a lot of purpose, and it reminded me how important it is in our business. And in life, just to surround yourself with people who challenge you in different ways to succeed. I talk with my girls about that all the time. Your associations mean a ton. So my encouragement to all of you is, whether you're running a business, you're building wealth, or just preparing for retirement, I think the important thing is when we're talking, because we talk a lot about money, when you're investing your money, it's not just investing money. You're investing in longevity and freedom and impact. And that's really what I got to see in interacting with 2 pretty phenomenal people.
That's pretty cool.
That's what we do here at Hobart Wealth as well. So if you want to hang out with me and do a cold plunge, just let me know.
I have not done a cold plunge yet with Chris. By the way,
it's all right. Are you ready, Jacob, to get to it?
I'm ready.
So as always, we're going to kick things off with our signature segment, the 3, 2, 1. Here's how it works, just to remind everybody. Jacob's going to share 3 key market insights. Then 2 portfolio spotlights of portfolios that are working right now or have a purpose right now. Right. And then we're going to have Andrew come and join us, and he's going to share a smart financial strategy that you can concentrate or use right now. So Jacob, I forgot my little thing here. So there's a 3, 2, 1 graphic. But all right, so Jacob Woodrum, are you ready? Because we're going to start with the 3. And here we go.
I am ready. Let's do it. So the first topic that I really want to talk about, we've been talking about these market highs, and I think a lot of people. I was just talking with Andrew earlier this morning. A lot of conversations around where are we at in the market, where things go from here. But a lot of people can get nervous when the market hits a record high, and we've probably all seen these videos, on TikTok or Instagram. But when it feels like stepping on a treadmill that's already running. What if you trip? You've seen that. I have not done that before, thankfully.
Yeah, well, it's scary because you see that high and
You do. It's what if the market suddenly drops 10%? The fears I think are certainly real, but the truth behind it is that new highs are normal. And it's interesting if you look at some of the data and the statistics, since the 50s, the S&P 500 has averaged double-digit highs every year. So
that's new highs every year.
Yeah, new highs. So it's not a finish line. It's more of a mile marker along the journey. And so I think that's important to mention. And I think we've actually got we may have a slide that shows this the market high, but the data would say it's not as bad as you would think. So history shows that I think starting at an investment at a record high really hasn't hurt that 1, 3, 5-year return. And the real risk isn't buying at the high. It's as we talk a lot about, Chris, it's sitting on the sidelines, waiting for the perfect timing that never comes. And so I think instead of fearing highs, think of as a reflection of sort of the progress of growth in the economy, over time.
And I love that, Jacob, because that mindset is huge. So often we hear folks kind of say that, I want to wait for the dip. I want to wait for the dip. And 6 months later, the markets are up another 10%. Not only have you missed the dip, but you've missed that upside.
Right.
And I think that concept that you can't build wealth by sitting on the sidelines is so, so true. Yeah. I think here's the thing. So often people look at new highs and they think it's a red flag, like watch out.
Right.
But oftentimes we have to look at it that it's a sign of progress, that things are moving forward. And again, every new high, it's not a guarantee of a new high, but if you have a new high today and it goes up, then tomorrow is also a new high, and it continues with that process. All right, let's keep going.
All righty. So let's talk a little bit about resilience. We want resilience to be our best friend. And so, if new highs aren't the problem, well, let's think about resilience, especially from a portfolio standpoint. So I like to think of resilience kind of like shock absorbers, on a long road trip. We're still going to hit bumps, but they're not going to throw us off the road. And so resilience, when we think about it from a portfolio standpoint, tends to come from 3 places. First, quality. You've probably heard us talk about this a lot, but strong companies with good earnings, cash flow, dividends that management doesn't want to cut. Valuation is really important. Price tells you the story, but value is kind of what we get and what we get paid over time.
And dig into that just a little bit. Like, when we hear valuation, break it down for simple.
Well, think about, the Magnificent Seven. Everybody's probably heard about those big name stocks, Apple, Microsoft, Nvidia, that have really been doing well over the last couple of years. They look expensive right now, but I think what's important to think about from a valuation standpoint is that there are some companies that look expensive, but they make money hand over fist. And so we want to have exposure to those types of stocks, not in total. We want to be diversified. And that kind of takes me to the third point, which is diversification. But, having different sectors that kind of take turn leading. So growth, like software, semiconductors, Nvidia, we've heard a lot about. Those tend to pair well with more steadier areas like healthcare or defense spending, aerospace, things like that.
And I think that's the key. It's almost like the seesaw, right? You got to have that level of balance. You can't always shoot for the moon.
Yeah, that's right. And I think we got a second slide. I think this is the last one for me on the slide standpoint, but just talks a little bit about the diversification. I think what's so interesting, is the more diversified a portfolio, the more likely we see growth, over time. And so what we're looking at here on this slide, we're looking at S&P 500 versus a diversified portfolio, and it's measuring different periods of time. So, 2000 to 2002, we see, what the return of the S&P did versus a diversified portfolio. Well, that's great. We didn't take as much downside. Well, on the flip side, you could look at 2009 to 2017, and you might say, well, my gosh, S&P up 260%, I'm only up 152%. But if you again kind of pull the lens back and then see just overall the total return versus S&P versus a diversified portfolio and the growth of, in this example, $100,000, the diversification really is important and really makes an impact. So I think, well, go ahead, Chris, you were going to say something.
No. I mean, that's always amazing because look, everybody wants to get the full upside, and you got to be, in order to take the full upside, oftentimes you got to be willing to take the full downside. And this slide right here is a great example showing that it's not always worth it. If you take the full upside and the full downside versus diversifying that portfolio and getting a good chunk of the upside, but also limiting the downside, that process, and it doesn't when it's happening.
Right.
When you're missing that
Right.
upside, it doesn't make sense. It
Right.
doesn't,
Doesn't
feel
feel
good.
right?
But you do the math, and the
Mhm.
math feels good.
Yep, that's right. And I think blending, you're by blending, we're not betting
Mhm.
on just a one type of weather. We're sort of packing for all seasons,
Mhm.
and that just allows us, to your point, Chris, to really build that staying power, in the market.
Yeah, and I think that the pack for all seasons analogy, that's really good.
Mhm.
We see this all the time. Clients with resilient portfolios aren't thrown off
Mhm.
by volatility.
Right.
They're prepared for it.
Yeah.
All right, Jacob, take us home.
All right. So the third and final point here, I want to talk a little bit about a playbook, kind of a simple playbook that, helps us kind of weed through market noise. So, markets, when they feel uncertain, it does help us to have a playbook that we can stick to. And I've kind of broken this down into 4 parts, but, first, and we work through this with all of our clients, is, decide on our time horizon, not the headlines, because, money we need soon, let's, keep it safe. Money for the long term, let's let it work.
It's kind of that bucketing system.
Yeah, exactly. A bucketing strategy. Secondly, kind of automating our entry, set a schedule, stick to it, so we're not trying to kind of second guess, every market wiggle. We're not second guessing, oh, should I be in the market at all time highs or should I be in cash? We talk about this again, quality investing in quality and cash flow companies that, really just help us sleep good at night. And then fourth, we rebalance with purpose. We're going to trim winners. We're going to add to laggards and kind of stay aligned with our plan. It's easy to chase the headlines, but try not to chase the headlines. And a lot of times writing down our rules, simple rules are what kind of can save us when our emotions kick in. So, volatility, the reality is it's always going to show up, elections, tariffs, geopolitics, it's always going to be there. But, I think this is key. And I'm not preaching. I mean, if anything, I'm preaching to myself more so is, long-term returns really, they do live in that gap between our short-term fear and kind of these steady fundamentals. So we don't need the perfect entry. We just need to have a durable process.
And I love that because, as the person managing and building and putting structure behind all the portfolios, you have rules. It's, sometimes we get a client that might call and ask and say, hey, I'd like to do this.
Right.
Well, if it's inside of a managed portfolio that we're managing based upon rules, we have to say, okay, we can do that outside of that portfolio. But this portfolio has rules that we're sticking to because we have a standard of what that looks like. We don't want to break that. And I think that's important for a client from their perspective as well.
Yeah.
Sticking to it, that is a big piece of the battle because there's always something, red shiny objects that tempt us.
Yeah.
So, all right, are you ready to move on to the 2 big things or the 2 portfolio spotlights that are kind of moving and shaking right now, or maybe something for people to focus on right now?
Let's do it. So first portfolio is what we call our income growth plus strategy. And we've talked about this before, but it's, the way I like to think about it is dividends while we grow. The takeaway is it's a portfolio that's a mix of stocks and bonds. It's really designed to give us steady income, but still growth potential. And I think that's the key, is the growth potential, because it's about a 60-40 stock bond mix. And it aims to really give us that regular income through dividends, through equities and through the coupon payments that bonds are paying. And we're just shy of a 4% annual dividend yield, so pretty close to kind of a 10-year treasury. But it includes more stocks than obviously a traditional bond-focused plan. So it really does have more potential, to grow over time, and it's more value focused. So I think it's a very smart option for investors who want solid income now, but don't want to miss out on long-term growth.
Yeah, and this is one that we kind of talk about. It's almost like a rental real estate.
Yes.
We need, a stock that pays a dividend is like that rental house, where the rental house is typically going to be going up in value, but you're also going to be collecting rent over time. And that's a dividend stock type of play, which is nice because it still gives you capital appreciation. Usually you're not lighting the world on fire, but it's a consistency of that growth that's really nice.
Yes. So let's look at the other side of the coin, which is what our prime aggressive strategy. It's what I think of as kind of growth at full speed. And so that takeaway is it's a high growth strategy designed to really capture long-term growth or long-term gains across a full market cycle. And it's built with one goal in mind, which is growth.
And that's the rule.
That's the rule, right? The different than the income strategy, because we don't prioritize dividends or yields, but we're really just looking to, again, lean into quality companies with, strong fundamentals. It tends to be a lot of technology, consumer discretionary communications type stocks. And, again, some people, and even if you look at kind of, we're talking about valuations, you can kind of label those sectors as expensive. But, again, the reality is those companies make money. They're profit generating machines, and they do really tend to drive long-term market leadership. So, we're blending passive active approach within that strategy to really give ourselves kind of broad exposure, targeted opportunities to really just have kind of a well-diversified portfolio. It is positioned to navigate the ups and downs of a full market cycle while really staying focused on the compounding growth. So I think it's a good smart fit for folks who want to grow, but I think the key is understand that there are short-term swings, and so it's kind of part of the journey towards outsized growth is being okay with the volatility there.
Yeah, and something like this fits real well like into something that you're wanting to have, a Roth IRA, where it might be something that you're not going to be touching for a while, but you want to give it the ability to grow. But you're right, it is not for everybody. If you're more comfortable with a bit more turbulence, prime aggressive can be a growth engine for the long haul. Yeah. And I think that's I obviously, given my age and where I'm at in life, I like the growth portfolios. Right. But again, I'm willing and able to take some of those swings and kind of when they happen. I think two great portfolios that again, a lot of our clients are in both of those, and they serve different purposes for different clients. Right. So, well, Jacob, I appreciate the insight today. I think what you talked about today specifically around where the market is and people being a little bit scared of the new highs. Right. We're hearing that a lot right now, right. And I think everybody's saying when's it going to drop? And the reality is we don't know when it's going to drop, but it continues to go up, and you don't want to miss out on that. And again, proper diversification, following the rules. That's where we're going to get there. So, all right. Well, it is time for us to move on to the number one, and this is where we're going to introduce Mr. Andrew Greer. And Andrew is going to be talking about the one strategy that can give you a big impact right now. All right, Andrew, welcome to the table.
Thanks for having me.
Yeah, good to have you here. What's been going on in your world?
I just finished up my cold plunge and thought I'd come up here and join you guys. Yeah, not much.
Oh boy, and so funny story about the cold plunge, and I was sharing this with Jacob. I sent a picture to my family of me and a few other guys in the cold plunge, and the picture, everybody else was regular color. I was bright pink, and Blythe, my 12-year-old, has an immediate response, and she does hearts, and she said the other guys, and it's different color hearts that are all like regular tones, and then Dad, and it's bright pink, and she said he ain't like the others. And it was just, my 12-year-old Blythe is our little comedian, and boy, she was quick on that one. So yeah, anyhow, so we'll have to cold plunge at once.
Come on over. Come
on over. All right. So let's go ahead. Let's dig in. And I know, we were talking about what you were going to cover. And I think this topic that you're going to be talking about is very important because we're dealing with it with a number of clients right now. And
yeah, we are, unfortunately.
I think sometimes we forget that we deal with estate issues on a regular basis, whereas most of our clients, it's once in a lifetime or maybe twice in a lifetime scenario that you're dealing with some of this. So we really have the ability to give people a lot of great guidance with this. So go ahead and talk a bit more about this.
Yeah. So Chris, to your point, as wealth advisors, as retirement specialists, unfortunately, it is part of what comes with the territory. Mm-hmm. We get to experience the not so pleasant parts of later in life scenarios, whether it's health and financial and things like that. So again, with any topic that I bring to the Wealthologist, I want to make sure it's something that's timely and something that really I'm getting and seeing a lot of in our day in and day out interactions with our clients. And specifically, what I wanted to talk today is about proper estate planning documentation. Again, I think with what we've seen this year, we've seen an uptick with clients, family members, their inner circle of friends, unexpected death, disability, things like stroke, dementia, Alzheimer's. It's an unfortunate reality, and dealing with as many people as we do, we get to see the good and the bad side of proper planning. So, this year it's really underscored to me the importance of, number one, proper estate planning documentation, and number two, making sure that the financial advisor that you work with, and in your case us, has these documentations on file, so that when something happens and the family's going through this chaos mode and mindset, having that on file just makes that process a heck of a lot easier for everyone involved. So again, just want to go through, in my opinion, some non-negotiables when it comes to some of these documentation. So the first thing that I'm going to start with are wills. So wills, as most of us are aware of, wills allow us to direct how assets are distributed after death. So what I say is it allows you to get what's in here on paper, so that when you're no longer around, there's a guide that your family members and beneficiaries can follow. Specifically for our family, it allows you to name guardians for your minor children, if that is your situation. And it also prevents the state default rules from deciding for you with a lot of these decisions as well. So very, very important. And I'll throw this caveat out there as well. We have a vast network of estate planning attorneys. So as you're listening to this, if you're saying, man, I'm really falling short on some of this, well, let us know. We'd love to connect you with the proper professionals that can suit your needs. Okay. Number two is power of attorney. Now there's a durable power of attorney, which oversees finances, and then there's also healthcare power of attorney that oversees healthcare. What I'm referring to here is durable power of attorney with finances. So this allows you to authorize someone, family, friend, someone that's trustworthy, that you do in fact trust, to act financially on your behalf. This is absolutely critical if you become incapacitated. Now, the shortfall that I have seen this year, Chris, is where you have a couple, two spouses, that have named one another as the power of attorney, okay, which is all fine and dandy, right? But as we all know, as couples, we tend to age together. And as we age together, we have the ability to decline mentally together as well. So the scenario that I would like everyone to avoid is one in which you have only named one another as the primary agent, but you have not taken that next step to assign a successor agent or even a tertiary agent. So great time, great opportunity to get those power of attorney documents out and just make sure that you've got multiple lines of successor agents set up in the event that both you and your spouse decline at the same time.
And I think something important with this too is when we're talking about powers of attorney, these are, a will is enforced when you're no longer here. Right. Power of attorney is when you are here. Right. And I think that's the important thing is if you are not able to speak for yourself for whatever reason, you're in the hospital and somebody needs to make financial decisions, it gives them the ability to do that. Once you are no longer here, though, that power of attorney doesn't have any impact.
Right. Correct. And of all documents for us to have on file for you, this would be the most important, in my opinion. Not that we have to act on that today, but having that on file allows us to act very rapidly for you and the family if something does come up. Number three is medical directives, things like healthcare proxies, healthcare power of attorney, living wills. This allows you to name someone to make medical decisions on your behalf if you're not able to. I think the most important thing to consider here, make sure whoever you're naming knows that they are the one responsible for this, and make sure they understand where these instructions are. I think we can all admit that this is not fun conversation. You're not looking forward to talking about this over the Thanksgiving table coming up, but just very important to have these conversations and get ahead of that before something does occur.
Makes things a lot easier. Yeah. And it doesn't, again, to your point, it's not a comfortable conversation, but uncomfortable conversation is going to happen sooner or later. And if you can take that stress away from people in the moment, that's what we're talking about here.
Yeah, absolutely. Now, the last one is going to be trusts. Okay. So as I mentioned, wills are good for you to get what's in your head on paper, but really there's not a lot of legally binding nature to the will. That's where a trust comes in. Trust can help your assets avoid probate, provide privacy, streamline asset transfer. A lot of times if there are marital issues in your family down the line, if there's substance abuse issues, if you've got a spendthrift child that when they inherit your money, they're going to go buy a fleet of Ferraris, a trust is a legally binding entity that allows us to protect our kids from themselves, or our beneficiaries from themselves, essentially. Um, Corey actually wrote a really good article in our newsletter this month that speaks to proper account titling. Anytime there's a trust involved, if you have not read our newsletter this month, absolutely, that's our plug for the newsletter
There
today.
you go. I like it.
Definitely check that out. Some really good information there. But also with the trust, the last thing that I'll add is a trust allows you to have certain assets that would typically go through probate, allows you to have the trust to own these types of assets, so that even something like your house or your cars or whatever allows those types of assets to bypass probate as well. We see a lot of times you've got proper beneficiaries filled out on your accounts, which is good. That allows your financial investments to bypass probate. But a lot of times, you don't have the ability to add a beneficiary to your home. So a lot of times the house is what your largest asset is, what gets held up in the probate process. But a trust, if the home is owned within a trust, allows even that asset to bypass probate. So a lot of flexibility, a lot of benefit with trust. Does it cost a couple of bucks to set all of this up on the front end? Yeah, absolutely. It sure does. But I think the argument for that is the time and the money that it saves on the back end far exceeds the effort and the cost on the front end in setting all of this up.
No, I think that's a great point. Spend $1 today to not spend $10, to some time down the road, and also create the stress. Because again, these documents and all of this process, it just helps give rules and guidelines and settings to the inevitable that we all face. So having those documents in place, it's essential. Sharing them with us, it makes your plan stronger and more seamless. And really, our role is to coordinate your financial life with your estate plan to make sure that whatever happens, whenever it happens, that it is a easier process.
Yeah.
And more streamlined.
Yeah, my challenge to everyone listening, if you do not have these documents in place, that's okay. Let us know. We'll connect you with the appropriate professional to help you with that. Number 2 challenge is, if you do have these in place, next time we have a review, or if you want to send them to us earlier, let's make sure we get those on file for you. There's 2 places I like to store these. Number 1 is online with eMoney. That's your online account portal through Hobart. If you don't know how to access that, let us know. But there's a vault. It's a secure storage, online cloud storage that allows us to save things just like this online for you. We've also got our internal file system that will store that for you as well. So those are my 2 challenges to everyone listening today.
All right. Well, that's great. It's not just about having the documents, Andrew. It's actually about having the documents and then having them available. Yeah. And I think that's that's key. So great stuff today. All right. Are you ready? Because we are going to go into our next spot. To keep things moving, we're going to go to what's called the quick fire Q&A. And this is where I'm going to throw 3 questions at you, Andrew. And those 3 questions, what I did for these is I asked Google, what are the top 3 retirement questions people are Googling right now?
Google, not ChatGPT, huh?
I used Google for this one. Actually, I used ChatGPT, and it looked to Google for the answer, so or pulled from Google. So it's kind of how it went. So, all right. So if you're ready, first question: will I outlive my money?
Well, that's kind of everyone's mortal
right?
fear, right?
Well, that's a number one question.
Yeah. So the short answer is, not if you've planned right. We build income strategies based on lifespan, not just retirement date. So it's all about strategy, structure, and sustainable withdrawals.
Yeah, and that one is definitely for compliance reasons. Everyone's situation is a little bit different, right. But at the end of the day, having that income plan is what answers that question right. Much more than anything else. All right. Number 2, when should I claim my Social Security?
That's the first time I've been asked that question.
Yeah, right.
No, obviously that comes up for everyone, and there is no universal solution here. But the answer is it depends. So it depends on health and income needs and outside assets, of all matter. Claiming early, as most of us are aware, reduces your benefit. Waiting boosts it. So we'll run the math for you. Let us know that's something that I'd say is one of the most important decisions we'll make financially in retirement.
And I think the other piece that plays into that too is if you've saved a lot of money into your IRAs, when and how you take Social Security can be impacted when you take your required minimum distribution. So it's a lot more complicated than just, hey, should I do it earlier or later? It's a matter of what are the taxes, what does it mean for me touching my own money versus the benefit. So a lot of things to look at.
I mean, if you've got one high earner, one high earning spouse, and then one spouse that doesn't have much of an earnings record, I mean, that's a big variable as well, the spousal benefit. So.
All right, question number 3, and this kind of goes along with what Jacob was talking about. But what if there's a market crash right after I retire?
Yeah, well, that's something that we call sequence risk. We plan for it in advance. Jacob, I think you like to say a lot of times you can't predict the rain, but you can build the ark. So we plan for it in advance. You've got cash buffers, low volatility buckets. Mm-hmm. You won't need to sell in a panic if you're positioned correctly. And that's, again, ultimately what we look to avoid is selling off of assets that are maybe experiencing pain in that moment. And if you have not properly diversified or positioned yourself and not given yourself options, then that's very difficult.
Yeah. Well, there you go. Boom. That's quick fire.
That's quick fire.
How's that for you? We kept it down to 3 today because in the past we've done 5, and after a while it's just like, that's a lot.
I can ramble too.
Well, that was that. No, I'm just kidding you. All right, Mr. Greer, I appreciate your insight today. Again, the estate planning piece that you talked about. Again, personally going through that with my family, some of the things that we're going through with clients, specifically as of late. Just so important to tie us into that. Let us help you in that process in whatever way we can. We're more than happy to do that. So, Mr. Greer, I appreciate it. Thank you so much for your insight. Now. All right, I just realized we don't have the speaker going when that graphic popped up. Apologize about that. I was saying we are switching over to a segment called Hey Hobart. And this, from what I've been told, this is the favorite for our audience because they like to hear what other people ask us and our question and answer around that. So today, our question comes from Sandra in Charlotte, North Carolina. And she asked, hey, Hobart, I hear about all these investments, but I don't really understand how they fit together. Is there a simple way to make sense of it all? I think that's a great question, Sandra. Now, I want to walk you through a concept that we've talked about for years, and quite frankly, we kind of got away from talking about it, but we're going to be talking about it more and more because it just makes sense and it simplifies this concept. It's called the financial house. So when we're talking about the financial house, it's kind of like we would be building a regular house. Obviously, when you start with a regular house, you've got the foundation. Now, in the foundation of your financial house, this is what we consider safe money, right? Cash, CDs, fixed annuities. Typically, this is steady. It doesn't grow fast, but it keeps the structure upright and it's dependable and predictable. And this is what gives you confidence when markets wobble. The thing is, you don't build the roof first. You start with the foundation. Now, second part of that financial house is the walls. Now, this is where you might have things like bonds or structured notes, or maybe even some form of dividend-paying stocks can fit in there as well. But they're kind of like your load-bearing walls, right? They support the house, they provide income, and they create really the shape of your portfolio. Doesn't have to be flashy, but it is essential. Again, if you have foundation and roof, you kind of have a teepee. We don't want that. You got to have those walls. Third is the roof. Now, this is where typically your stocks live, but even the roof has layers, right? Dividend stocks, we often talk about kind of like the rafters or the plywood. That's going to be stable, reliable, income producing. Whereas those growth stocks that Jacob was talking about a little bit earlier, they're kind of like shingles. They're going to take the brunt of financial storms. Oftentimes, you might need to rebalance or reshingle over time, but you need both of those pieces for protection and lift in a storm or just to kind of go through any sort of economic ups and downs. Now, to kind of add a little bit more flavor, a lot of houses have fireplaces. You don't have to have a fireplace, but you can have a fireplace, and that's the same with your financial plan. This tends to be your higher risk, your higher reward type of investments. This might be things like private equity or alternatives, individual stocks, that are kind of high flyers, maybe crypto for the right person. Now, it can heat the house, or it can burn it down if it's not contained. So you got to be mindful and wise about that. Use in moderation with clear boundaries. And again, you would never build a house that is just a fireplace. That wouldn't be much of a house. Now, to kind of talk a little bit about rounding the picture out, you've got the fence. And this is what we would consider a little bit like Andrew talked about today. This is legacy and protection plan. These are estate documents, maybe life insurance, long-term care, making sure your beneficiaries are properly documented. Here's the thing. You might have the nicest house on the block, but without a fence, you're going to be a little bit more vulnerable. The thing is, none of us would just live on a foundation. And you wouldn't want to sit in a fireplace every day and call that your house either. You got to have the whole structure. And quite frankly, that's what we do. We help people build that. And a complete financial house that is customized to their life and legacy is exactly what most people are looking for. Now, I hope that answered that question. If anybody else has a question for a future episode, send it to us at heyhobart@hobartwealth.com. Folks, this wraps up the Wealthologist Live for this month. Big thanks to Jacob and Andrew for all of you for tuning in. And next month, we're going to take some time. We're going to break down some of that year-end planning that needs to happen in that last quarter. So we're going to be talking Roth conversions, tax loss harvesting, and really how to finish the year strong, no matter what the markets do. Until then, build wisely, protect intentionally, and keep living your wealthiest life. See you next time.